Imagine you're watching the latest episode of a finance podcast and the host dives into a story that grabs your attention immediately. It's not about a tech giant like Tesla or Nvidia going public, but rather a two-wheeler dealership that's managed to whip up an IPO frenzy of its own. Yes, you heard that right. A 12 crore IPO from a relatively unknown Delhi-based company called Resourceful Automobile has taken the market by storm, making headlines with a whooping 418 times subscription rate. In fact, the retail portion alone was oversubscribed by 496 times. Let's get into the details. Resourceful Automobile, operating under the name Sani Automobiles, was founded in 2018 and serves as a Yamaha two-wheeler dealer. It's a modest operation with just 2 showrooms and an attached workshop in New Delhi, employing a total of 8 people. Not exactly what you would expect from a company generating such buzz, right? With such staggering subscription numbers and a strong grey market premium, everyone expected the shares to debut with a bang on the stock exchange. But here's where the story takes an unexpected twist. Despite the hype, Resourceful Automobiles shares listed flat on Dalal Street, surprising everyone who had expected a strong debut. This event caught the attention of market watchers and investors alike, especially after the SEBI issued a warning about the overexcitement in the SME IPO sector. The frenzy around the SME IPO isn't new, but this year has seen unprecedented activity. To give you a bit of context, take a look at this chart to understand how fundraising through the SME IPO has been at record highs. The SME IPO segment, which was launched back in 2012, designed as a platform for small and medium enterprises to raise capital. And the last 2 years of 2022 and 2023 have seen more than 4,500 crores being raised through SME IPOs. These aren't your regular IPOs. They're specifically meant for SMEs, offering a way for these smaller businesses to access public funds and grow. This year, several SME IPOs have seen massive oversubscription and impressive listing gains, drawing investors in droves. The S&P BSE SME IPO index itself has skyrocketed by 89% in the past 6 months and an eye-popping 185% over the past year. Now you might wonder what sets the SME IPOs apart from the main board IPOs of larger companies. The main difference, as we explained, is that the main board IPOs are for larger established companies, while SME IPOs cater to small and medium-sized enterprises at earlier stages of growth. Companies with minimum post-issue paid-up capital of Rs 10 crores can raise funds and get listed at the BSE and NSE exchanges through mainboard IPOs. Companies with minimum post-issue capital of 1 crore and a maximum of 25 crores are eligible for SME IPOs. Unlike mainboard companies, SMEs aren't required to disclose their financial results quarterly. Half-yearly reporting is sufficient. They also have fewer obligations around related party transactions and other disclosures. The minimum investment for these IPOs is generally higher, often requiring at least 1 lakh to ensure that participants have certain risk appetite. While the lure of high returns being real, some investors have seen with companies like Winsol Engineers and KC Energy and Infra, which delivered impressive listing gains. But not every story ends up on a high note. Take MVK Agro Food Products and Italian Edibles, for example. These companies listed with losses of 31% and 15% respectively, serving as stark reminders that not all that glitters is gold. So what's the bottom line here? SME IPOs can be incredibly exciting and potentially lucrative, but they come with their own set of risks. Not every SME IPO will turn into the next big thing. Many of these companies have vulnerable business models, and investing in them without thorough research could lead to significant losses. That's not to say every SME IPO is out to scam investors. Many are genuinely looking to grow and thrive. But investors need to exercise caution. Due diligence is key. Take the time to evaluate the company's business model, its financial health, the industry it operates in, and the quality of its management. Diversification and a strong risk management strategy can help mitigate the inherent risks of investing in SME IPOs. After all, in the world of investing, the only certainty is uncertainty. So approach SME IPOs with both enthusiasm and caution, and you just might find the right balance to unlock high returns while safeguarding your investments. Having said that, this is me, Ralston, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.